Facebook live stream. It's great to see you, and thanks for the questions. I've got a lot of questions to answer today, and we'll get stuck into them in a minute. I just wanted to say, firstly, remember the live stream is general advice only, and may not be appropriate for you. Now, I did a webinar last Saturday for NGS Super, and it was very interesting. We involved Ben Kingsley, who's a property advisor, a property expert advisor, and he's written this book, Armchair Guide to Property, which is a pretty good book. Anyway, so I got Ben back for an interview for you. So he's in this week's Talking Finance. I think he's on the site today, talking about negative gearing. He reckons negative gearing is crazy as a strategy, as a long-term investment strategy, and he's quite convincing on the subject. It's just a short-term thing to cover you for losses while you're waiting for your property to become positively geared. That is to say, paying you an income. And I must say, it made a lot of sense. So that's really worthwhile. And I've got a couple of other interviews going up today, which really are very interesting. In particular, there's a bloke called Eric Wilson who runs a startup called Xinja, Xinja, which he's calling a neobank. Now, there's a bunch of these in the UK apparently, and they're starting to pull a lot of market share off the major banks in the UK. Xinja appears to be the first in Australia of these neobanks. Basically, they're entirely digital, mainly on the phone, and they're getting a license. So they're not non-banks, they're banks, and very, very interesting development. So I've spoken to him. Not that you can invest, you can't invest in Xinja even if you wanted to, but it really is about what impact they might have on the banks that you probably do invest in. So that's very interesting. And I've also spoken to Tom Elliott. You might remember him if you're an old Eureka subscriber. Tom used to write about takeovers for Eureka, and runs a takeover fund for Bueller Capital. He's also chairman of Bueller Capital, and is also the drive presenter on 3RW in Melbourne. Anyway, he kind of invests in takeovers both after they're announced and trying to pick them before they're announced. And there's quite a lot of takeovers going on at the moment, worth looking at in terms of investment strategy. The one thing that Tom does that's quite interesting is he has traditionally, as soon as a takeover is announced for a company, he would usually buy into that company after the first takeover has been announced, because most of the time the final price is quite a bit higher. So it's a sort of almost a guaranteed way to make money. So he's doing that, but he's also now looking for stocks that he reckons will be taken over, and he's given us a few ideas, so that's worth checking out as well. Buffy and James, by the way, are having so much fun with the Curious Investor interviews, our community interviews, that talking to members of Constant Investor about their stories and their investments. So we'd love to hear from you as well. If you would like to share your story with us, we'd love to hear it. Drop a line to Phoebe, just at the hello@theconstantinvestor.com email address, or just email me if you like, alan.kohler@theconstantinvestor.com, and I'll pass it on. So let's get into the questions now. And there's some terrific questions today. And if you want to ask a question now, please feel free, and we'll get to it as we're going along. Because after all, this is live. Andrew says, "Hi Alan, if you could arrange an interview with anyone in the finance, business or investment world, who would it be? Why would you like to talk to them? And what would you ask them? And if it's Buffett or Bezos, could you think of any original questions that they haven't already answered?" Yeah, look, I probably would like to talk to Jeff Bezos, the founder and CEO of Amazon. I think he's probably the most interesting person in business in the world at the moment. Not not really Warren Buffett anymore, although obviously Warren Buffett's always worth listening to, and I'd probably love to interview Charlie Munger, his offsider, who comes out with some very pithy statements. But I must say that there's no way I don't think I could think of questions to put to Jeff Bezos that he hasn't already answered. But what I would like to know is, what's the plan? I mean, that's what I'd like to draw out of him is, what's Amazon going to be like in 10 years' time? I mean, what does he think? What's the plan that he has for this amazing business? And what does he mean by customer focus? I mean, just how focused are they? I'd love to draw some of that stuff out of him. That's who I'd like to talk to. That's for sure. Another Andrew says, Warren Buffett said, if a far-sighted capitalist had been present at Kitty Hawk, he would have done his successors a huge favour by shooting Orville down. What's happening is Buffett is pulling out of retail and investing in airlines. Our airlines basically already autonomous with their top technology. Not quite sure what you mean there, Andrew, but it's certainly true that Qantas has been a fantastic investment, but Virgin has not. And so Qantas is still going strong. I think Warren Buffett's old story that if he ever feels the urge to invest in an airline, he has a lie down until it goes away. That's always been his line on airlines. Not quite right. Certainly hasn't been right about Qantas. I mean, it may be true about American airlines, and obviously the European cut price airlines have been causing havoc over there. But Qantas, what a fantastic business that is. So, I think that and Warren Buffett pulling out of retail, which is fair enough, given what Amazon's doing to them, and starting to invest in airlines. Well, it just shows that the tide maybe is turning on that score. James writes, you asked Darryl Wilson if he thought future generations would be a good stock for a young person to use dollar cost averaging on. What else would you suggest young people look for in an investment that would benefit from dollar cost averaging? Just to remind you what dollar cost averaging is, it basically means putting the same amount of money each month, or each week or quarter, but usually each month, into the same investment. It's a market-based investment, so that when the price goes up, you buy less of them, and when the price goes down, you buy more of them, so that you actually get the benefit of the volatility rather than having it work against you. And the idea is that over time, you do really well, because you tend to, as I said, buy less when the price goes up and buy more when the price goes down, which is a fantastic way to invest. So dollar cost averaging is a great long-term investment strategy for a young person. It works best, firstly, if you're buying the same security, whatever it might be, and secondly, it also works best if it's a market security that does go up and down. If you're just buying buying units in a trust, that would tend to be less volatile. They do tend to be a bit volatile, but not very. So future generations, yeah. Look, I think that is a good idea. I mean, I suppose a lot of people sort of talk about dollar cost averaging in terms of ETFs. That the best thing to do with them is ETFs. My view is that you need to probably do better, and you can do better as a young investor with many decades ahead of you. You can do better than just investing in the market, whatever it might be. So I wouldn't, for a long-term investor, I don't think an ETF is the way to go. You're much better off getting a higher level of compound interest with a managed fund, whether it's Future Generations, which has been averaging, I think, 10% or so, which is better than the market, or you go for one of the funds that are LICs that are sort of been doing more than that, 10 to 15% perhaps. So yeah, look, I think LICs is the way to go for dollar cost averaging, and best to get one that is likely to produce good long-term returns. I mean, I've talked about Bailador before, Bailador Technology Investments. That's a second stage an investor in second stage startups. The reason I think that's an interesting play is that for the long term is that because it's looking for they're actually targeting 25% compound returns, have been getting that. Whether they can continue to get it, who knows, of course. But look, I think investing in venture capital is a good long-term strategy. Possibly, you might split your investing between something like that and something more sort of conservative and traditional, like Future Generations, or even Argo, Milton, or AFIC. Although they kind of tend to be indexy type of things. They're not ETFs. They're certainly active funds, but because they kind of hug the index a bit, they tend to be close to the index. But at least they're making decisions as opposed to ETFs that don't. What I think about ETFs, just as a sidelight to that, is that if you're going to invest in them, you're best to try to, rather than use dollar cost averaging, to try to pick the tops and bottoms, to sort of try to time the market, which is why we've teamed up with Percy Allen and his newsletter Market Timing, which is coming into, which is now starting to come into Constant Investor, and I'm pretty sure it'll come to you this week. If not this week, then definitely next week, as a part of your Constant Investor subscription. And Percy's signals are specifically aimed at ETF investors. Edwina says, what is your view on investing in traditional retail? Herringbone Clothing has just announced they're closing down. Oraton Group shares have tanked over the last year with whispers of a buyback. What do you think of investing in the rag trade? I don't think much of it, to be honest. Premier Investments has probably been the best investment because Solomon Lew is such a terrific retailer, and so is Mark McInnes, his CEO. So they've done pretty well, but I do think all of them are going to get hit by online retailing now, and specifically by Amazon. I think that Amazon is going to have a massive impact, and not just Amazon itself, but the way that it's likely to open up online retail into clothing more and more, I think is a genuine threat to clothing stores, and I don't think much of them at all. I think that the fact that they're largely getting into trouble is an indication of that, and that's even before Amazon arrives. So, Rhodey's got a couple of questions. As an investor, do you treat product-based companies and service-based companies differently? And what advice do you have for anyone wanting to invest directly in a startup? What's your top criteria for evaluating a startup? Well, I suppose you have to assess all companies slightly differently. I think about service-based companies, it depends a bit on what they are, but often they tend to be selling time. That is to say, charging by the hour for their service, whereas a product tends to be more a margin thing, where you have a fixed cost base, raw material cost, and so it's about the marginal cost of producing the product on top of fixed costs, and it's much more susceptible to that kind of analysis. Whereas with service-based companies, it's all they tend to be more all variable costs, except if they're SaaS, that is software as a service. And I think that these days the best service companies to get involved in a sense, they're a kind of hybrid in a way between a product and a service company. Whereas SaaS companies, they have a product, whatever it might be, but it's a software as a service, such as Xero. I've just been interviewing Rod Drury, the CEO of Xero, today. Now, they're a SaaS business. They've just passed 1 million subscribers. Their ARPU, their average revenue per user, is $28 per month. But they're getting 80% margin because their costs are mostly fixed. The service they're providing or the product they're selling, which is kind of as I say, a cross between a product and a service, has almost a zero marginal cost. Most of their costs are fixed. So as new subscribers are added, the revenue mostly falls to the bottom line. So where possible, look for those kinds of businesses. I interviewed Dropsuite recently, which is a backup service. You might remember, what's his name, Sharif Al Ansari. So have a look at them. There's an interview with Sharif on the site about Dropsuite. Now, that's another interesting hybrid between a product and a service. It's a service but a product, very high margin business. So those kind of things are the things to look for. Manufacturing products obviously depends on, selling a lot of them. If they sell a lot of them, that's fine. What advice do you have for anyone wanting to invest directly in a startup? Well, the most important thing about a startup is the people. It's when you're investing in a startup, you're investing in people, and it's really to do with your assessment of them, and what you're looking for in the person is not just passion, because everyone's, when people are starting a startup, they're passionate always, but you're looking for someone who's got persistence and stamina. That's the main thing. I've invested in a couple of startups, but I've done it only on the basis of the people concerned. Obviously, you have to have a decent idea, has to be a reasonable idea, but ideas in a way are a dime a dozen. There's tons of ideas out there. It's the execution that matters, and the execution depends on the person. That's kind of it. Barry says, water that plant behind you and give it some sun. Poor plant. I know. You're right. It's getting sun from the window. Is it due for some water? It probably is. No, it's had some water. It's had some water, Barry, but I'll look after it and I'll give its leaves a bit of a wash. Ian says, hi Alan, if we value a house as land content plus replacement cost and we have a price correction over the coming years, how will local and state governments reduce the land value content if their revenues are linked to this valuation? The replacement cost cannot be the only component that can contract. Consequently, will there be a house price correction, or will it be limited to units, apartments only? Interesting question, Ian. Well, the thing about it's interesting, isn't it? Because the thing about houses is that land goes up in value, but the house goes down in value always. Houses depreciate, and it gets lost or buried in the appreciating or rising value of the land. And land does correct from time to time. Not that much in Australia. We haven't had huge corrections, although let's face it, we've had quite a big correction in Perth, 30%, I think, of house prices in Perth. That means, what we're talking about is land going down in value. Karratha, prices have gone down 60-70%, simply because of the end of the mining boom, and that's land. So you can have corrections. Mostly in Melbourne and Sydney, if you look back in history, the corrections are between 5 and 10% fall, and then they recover. And so that's the sort of correction you can expect. And when that happens, revenues of state governments and local governments do tend to go down. But remember that the state governments get their revenue from stamp duty, which is based on transactions. Now, it is true that as the value of houses and land falls, obviously the amount they collect as stamp duty also declines to some extent. However, for them, what it's all about is the number of transactions. And there does tend to be, when there's a correction in the housing market, there does tend to be a big fall in there does tend to be a big increase big increase in the amount of transactions because lots of stuff is coming on the market. And so it doesn't necessarily mean that the state government's revenue falls because they still get a lot of stamp duty from the transactions taking place because a lot of stock can come onto the market, a lot of people are trying to sell. It is the case, if there's a big fall, that local governments' revenue from rates tend to fall because because the rate values are based on the value of the land, but that takes ages. They're very slow in adjusting their valuations. They're much slower adjusting their valuations down than they are up, I can tell you that. So I think it's likely there will be a house price correction. It won't be limited to units and apartments only, but it probably will be mostly units and apartments, mainly because there seems to be a bit of an oversupply of them, because there's a lot of stock still coming onto the market. So you can expect, I think, a fair bit of selling to go on there. And I was talking to an apartment developer the other day, in fact, and he was just saying that we're starting to see a lot of Chinese buyers pulling out now. They did come back, they came back for a little while, now they're starting to pull out and they're not settling. And so developers could start to go broke fairly soon. And as developers start to go broke, that stock is going to come onto the market because the banks will start selling it after they go into receivership. So I'd say there's likely, you're right, there's likely to be a bigger correction among units and apartments, but that doesn't mean there won't be one in houses. Jeff says, hi Alan, what's happening at The Economist with recent articles praising Karl Marx for identifying businesses as rent seekers, describing Google, Facebook as vultures and advocating government intervention to counter their market power? What's your opinion of this seemingly rapid change in economic beliefs from total faith in markets to more government intervention? Yeah, look, you're right. I've noticed a bit of that myself, and I think that there is a bit of a shift towards government intervention. We're seeing it in Australia with the recent budget, you know, when the rhetoric of the coalition has gone from being, you know, it's all about withdrawing government to being more about, you know, government being involved, such as, you know, increasing taxes and so on. And I think there is a swing going on. Whether The Economist is leading it, possibly. But I remember when Ronald Reagan was in power, his big thing was governments are not the solution; they're the problem. And yeah, well, as to whether The Economist is really praising Karl Marx, I don't know about that. But yeah, I think it's very interesting, and there's a bit of a change in sentiment about Google and Facebook going on. That's true, and outfits like Uber and so on. I mean, they started off being seen as, you know, these cool, almost messiah-like businesses, but now that's definitely changing. Partly because of their tax practices, but also because they're being seen as vultures. And you wonder whether at some point we'll get some sort of antitrust action against them, as there was against AT&T, where they were required to bust it up, you know, to break up AT&T, and you wonder whether that might be around the corner for some of these big monopoly digital businesses. Very interesting. So yes, Jeff, thanks for bringing that to our attention. Robert has two questions. Alan, what are your thoughts on US subprime car loans? And Alan, the AUD, Australian dollar, is known as a commodity-based currency that has a stronger influence on the Australian dollar. So what has a stronger influence on the Australian dollar? A slowing China economy, the US Federal Reserve raising rates, or both? I do note Moody's downgrade of China yesterday. Yeah, look, people have been talking about US subprime car loans for quite a while now, and whether it's a problem, to be honest, Robert, I just don't know. I think not. But I don't really know enough about it. I'll look into it, but I think that I don't think it's of anything like the same scale as as the subprime home mortgage was in 2007. But look, so I suspect there's probably something going on there, but not nothing like what it was with subprime mortgages. As for the currency, I think it sort of ebbs and flows, to be honest. There are times when commodities have more of an influence than the interest rate differential, and vice versa. So it is definitely both, not one or the other. You might note, as you say, Moody's downgraded China yesterday, but and everyone carried on about it at the time. And a lot of the financial reports during the day talked about, big reaction on the market. When I got into the ABC yesterday afternoon, I'd heard a bit of this and I thought, oh crikey, there must be a big sell-off of the dollar, the Australian dollar, because of the Moody's downgrade. And in fact, it had gone down, I think, 40 basis points from, 75 to 74.6. So hardly a big move. So you might have seen me on the news last night basically talking it all down as being a bit of a storm in a teacup, which I think it was. I mean, that's a particular thing. Obviously, commodities do tend to influence the Australian dollar. But it's very interesting. I mean, we've seen huge moves in commodity prices over the last few years, and also big changes in the interest rate differential, and they've tended to cancel each other out a bit because we've seen the Australian dollar cycling around 75 US cents for 2 years, basically, all through last year and through half of 2015. The Australian dollar's been around about 75 cents, so it hasn't really moved much despite all the big changes in commodity prices and the interest rate differential with US interest rates going up and the Australian interest rates coming down last year. Matthew says, hi Alan, Vocus has done a Lazarus, rebounding a fair bit from the low short term. Is it a short-term rally or M&A potential? I think it's M&A. I think that Vocus, I haven't mentioned this yet in any of my writing in it, but I think I will this Saturday. I think Vocus is probably going to be taken over. Tom Elliott might have actually mentioned it in my interview with him, so keep an eye on that. I'm pretty sure, it's all phasing in my head, but I'm pretty sure Tom made it one of his potential takeover targets. So I do think that it's a potential M&A target. Barry, hi Alan, saw you the other night on ABC chatting about Bitcoin. If you bought $100 of the encrypted currency in 2010, it would now be worth $75 million. Move over gold, cobalt, medical cannabis, encrypted currencies are where the money is at. Well, certainly where the money has been at, that's for sure. There are now about 24 or 25 cryptocurrencies, obviously the leader of which is Bitcoin, but there's tons of them, and they're all an absolute mystery to me. I mean, I've never really invested in gold because I don't understand that market, and I tell you what, I really don't understand Bitcoin. I'm starting to report it on the ABC News because, well, it seems to be a big deal, and it's $2,500 a pop now. And as you say, it was not very much 7 years ago at all. I mean, I'm not sure whether, is that right? $100 to 75 million? That seems like a lot. But anyway, it certainly has gone up quite a few %,000% over the last few years. And anyone who invested in Bitcoins, then it's certainly looking pretty. I think Mr. What's his name? Satoshi Nakamoto, who invented Bitcoin, is said to have 1 million of them. So he's now, if that's correct, he's now a billionaire. Looking very happy. Jeremy, would you buy Facebook, Google, or Amazon? think Amazon has just started. And the thing about Amazon, which I like, is that it's got more than one business. The web services business is growing rapidly, fantastic business. And online retail, I think it's really, it's got the formula, it's got the formula right. And so, if of those three, if you ask me which of those three I'd buy, it'd be Amazon. Although I think Facebook's a pretty good business too, I must say. But yeah, Amazon. Allen, are you concerned about the looming inability of US pension funds to earn enough return to honour their obligations? I haven't been, I admit, David. Maybe I should be. Now that you've brought it to my attention, I'll have a look and find out whether I need to be concerned. I think I wouldn't be surprised if there's a problem there, because they do tend to have a lot more defined benefit pension schemes in America, which are usually underfunded, and so there could be a problem coming up, but I'll check that out. Duncan says, could you put up a list on your website of all the companies you've got on the list to interview, plus any updates on the Morningstar fund ratings on the site? They haven't been updated as of last week. Is that right? Okay. Good idea, Duncan. Thank you. Ian says, Alan, do you agree with the comment made by Hamish Douglas that Uber is a pyramid scheme and that it will die within a decade? Look, I think it's clearly an interest. It's clearly, I mean, I saw that comment by Hamish, and I generally make it a habit not to disagree with Hamish Douglas, because he's a very smart person, and if he reckons Uber is a pyramid scheme, well, possibly it is. I do think that the sharing economy is going to be with us, is permanent. I think that's here forever. Uber, however, in some ways a bit like Twitter, in that they kind of are regarding themselves, they're carrying on as if they're a technology business, when in fact they're just a taxi business, really. And so, and Twitter has a couple of billion users, should not be losing money, is losing a fortune, because it employs too many people and is paying them too much. And I suspect Uber is much the same. They're just paying people too much. They're losing money when they shouldn't be. They should just be making a fortune, but they're not. So that's what I think about Uber. I mean, I don't quite know what he means by it being a pyramid scheme. Maybe I'll have to ask him. But I do think there's serious problems with Uber and the way they've structured the business. However, I think the sharing economy in general is going to be around for a long time. Ted says, CommSec have an email and push notification alert service for when a company releases market-sensitive information. It's been really useful, but they don't offer anything similar on their international platform. Are you aware if there's a product out there that can keep me notified of market-sensitive announcements for stocks outside of Australia? No, I'm not. No, I'm not actually. There was something. Have you looked at Simply Wall Street? They've got it's not just a notification service. They're a stock valuation service and stock information service. So they provide sort of updated information, and they're a subscription service. So they're not free. But I do think Simply Wall Street, someone you might have a look at. They certainly have news, and whether they have an alert notification service, I'm not sure, such as CommSec. If you the other one, I get an email every day from Fortrend Securities, which is sort of I don't know how comprehensive it is, but it certainly gives some daily updates on what's going on in the US. Fortrend is a local stockbroker. Now, I mean, I'm not a client of theirs, but they send me an email every day. Maybe you can easily sign up to one of their emails. Dimity says, "Hi Alan, if I'm not too late, I'd love your perspective on Afterpay." You're not too late, Dimity. They've just won FinTech of the Year award, yet a merger is on the table with Touch Corp. In principle, is it better to invest prior or post mergers? Afterpay, it's an interesting business, and we've had them. I think they're one of our top stock picks. They are. Hugh Robertson picked them, as did someone else. But Afterpay, they kind of work online, but they're really a traditional lay-by business. So it's not like there are, a lot of these businesses call themselves fintech, but actually, or they call themselves tech, but actually they're pretty basic, old-fashioned type of businesses. They just happen to sell their service or product online. And I think Afterpay's in that case, and I think it's a great business, no doubt about it, and they deserve the award. The merger with Touch Corp, I don't understand. It seems to have been a takeover of Touch Corp by Afterpay. I'm not really sure, but also Touch Corp has separately announced or told the market that it's had another approach from somebody else. So I'm not sure whether the thing's going to go ahead now if somebody else comes in over the top of Afterpay. In principle, is it better to invest prior or post mergers? Well, most mergers don't work out. Most mergers are a waste of money by everybody concerned. Not all of them. Sometimes they're great, but most of the time the bidding company overpays for the target company, and it turns into a bit of a debacle usually. But so that would suggest afterwards, not before, I would say. So best to invest afterwards, see what happens, see if it works out, and take your time. That's what I would say about Afterpay and Touch Corp. I'd wait and see. Alan, have you looked at Stockopedia? Says David. No, not really. What's Stockopedia? I'm clicking on it now. Your personal stock market sidekick. Beautifully designed online application that gives you everything you need to beat the stock market. There you are. So that's a tip from David for everybody. Stockopedia. That's stockopedia.com. So might be worth a look. And finally, Matthew says, "Hi Alan, are you across the G8 education share placement? If so, could you explain this, as I'm a bit confused about what has happened on 23rd of the 5th. No, I'm not across it, I'm afraid, Matthew, but I will get across it and see if I can get them on and grill them about it. What do you reckon? So if you've got any questions specifically, Matthew, let me know and I'll ask them of them, and I'll get them on the show. I'll get them onto our podcast next week. How about that? Another one. Thanks, Alan. What is the best product way to buy stocks in the US or Europe? Well, most of the local online stockbrokers, CommSec, ANZ Share Trading, NAB Trading, most of them allow you to buy through them, US and European stocks. So it's probably the best thing to do is to use them. Another way to do it is if you're happy with ETFs, is to go through the Australian Stock Exchange, the ASX, go onto their website and look at the list of exchange traded products on the ASX site. Just Google ASX exchange traded products, you'll get the list, and you'll see lots of ETFs that provide a way into either the US or the Europe that way without having to pick a stock. And the other way, and you'll see it also, there's a list of listed investment companies on the ASX that invest actively in US and European stocks, so you could do that There's a few, obviously there's a few local fund managers that invest globally, such as Magellan and Platinum, and there are a few others. So that's what I'd suggest. But if you want to buy direct stocks, you can go through your local online broker, or you can develop, of course, you can start up an account with a stockbroker, either here, a stockbroker such as Fortrend, which is a specialist on US stocks, or possibly get an account with someone like Merrill Lynch. They have an office here, or even one of the big brokers such as Citi. They'll probably open an account for you as well. I mean, it might not be very cost effective. They're probably quite expensive. I've never really investigated what the costs of that are, so I'd probably go through CommSec or ANZ Share Trading, which I've done a bit myself, buying through ANZ Share Trading, which is my online broker. Well, that's it for questions. And remember, the live stream today was general advice, may not be appropriate for you. It's been great talking to you. Thanks very much for joining me. As for our interviews next week, worth mentioning, we've got, I've just been talking to Martin Nicholas, the CEO of Green Cross, and among other things, he told me that part of the growth of that company is all about the fact that pets are people too, and people are starting to treat their pets like human beings. So even though the number of pets is growing at sort of the same as the population, about 2%, the amount being spent on the pets is at least double that, and growing at double that rate. So anyway, I mean, Green Cross's shares have fallen a bit lately. They've gone from $7 down to $5.50 because of the sell-off of retailers. He reckons that's not fair because they're also vets, but there's been a bit of a backwash on Green Cross because of the coming arrival of Amazon. And I'm also looking forward on Monday to interviewing Audrey Zibelman, the CEO of the Australian Energy Market Operator, because that'll be very interesting to give you an idea of what's happening in the energy market and how she's planning to change it. James is talking to Julian Beaumont of Bennelong Australian Equity Partners. Bennelong's a great investment manager in Australia, and Julian Beaumont will have some very interesting things to say, so keep an eye out for that. We had such a fabulous response from last week's fund managers question about how to value businesses that we're going to do that again with a different set of fund managers and put them all together. So there's tremendous engagement by fund managers to our questions in general, and Dave Thornton's running that process, doing a great job. We'll be asking them more. I think you should keep an eye on the stuff that we're publishing on Tuesday, that Dave's putting together, where he's bringing the fund managers' thinking, both on the questions we ask them, but also their broader thinking on the markets and so on, which is really fascinating stuff. They're really happy to engage, and really worth listening to, fund managers. So thanks for your company. I'll see you in your inbox on Saturday morning. See ya.